Where is the risk underpriced? What market?
Well, when you look at what's underpriced, it's hard to know, but I think what's certainly overpriced are treasuries in here. So I'm in Patrick Harker's camp that the
Here we go.
March
March is
meeting,
live.
it should be on the meeting.
Okay.
It should be live. I've been saying this since the election. I think we have to stop living in this fantasy world that with U.S. GDP coming in close to 3% and with inflation should come in at 2.5%, that 0.5% is the right level for the Fed funds rate. They've got a lot of ground to cover, and waiting until June doesn't make any sense to me.
Many people watching this program right now will agree with you, but many people have been conditioned by a Federal Reserve that is in a mood to move nowhere fast. And that's why they sit here and say, you know what, March live, really? We've heard this one before. Why is it different this time around?
Well, there's a big divergence in the markets, and I think Alex had a chart up a couple weeks ago that looked at the spec short position is at a very, very high level, but it's offset by a long duration position. So during the sell-off, speculators have been selling, money managers have been buying. That has to reconcile at some point. We were due for some calm and pause, and we're getting that now with 10-year yields trading between 230 and 260. I think as we start to see some of the policy stimulus take shape and form, then that will get yields moving higher. And you heard it from Chuck Stevens. He doesn't know what to do. On one hand, the border adjustment tax is punitive. On the other hand, if there's a cut in corporate taxes at the back end, that's very favorable. What's he supposed to do? He's just supposed to wait it out and see which way things break.
But in all reality, I mean, you're still dealing with the core of the Fed is particularly dovish. The last 2 years, they've come out and been stronger at the beginning of the year and then have revised down their rate outlook to meet markets. So based on that, if you're going to bet on a March rate hike, how do you also hedge the dovish risk?
Well, I think you look at other things in the market, and maybe you don't go at it from government bonds. You look at corporate credit instead, and you can still buy high yield at close to 6%, a 4% option-adjusted spread. And when you listen to the administration and all the policies they're talking about, you listen to Chuck Stevens, the bias is they're very corporate America friendly, so you should see that in an acceleration in earnings growth. And also tips look pretty good. Inflation is picking up, and it's not only in the G10, it's in the emerging markets. And if you look at 10-year tips, they're around 2%. They belong at around 2.5%.
Well, it tips the hedge for the dovish Fed. I mean, you mentioned GM's Chuck Stevens. He doesn't know what to do in this environment. Why is Fed Chair Janet Yellen going to be any different? And if the Fed's going to sit there and be patient, then inflation is going to carry on bubbling away and the Fed's just going to let that go hot for a while, aren't they?
Well, they can do that. They can sit back and say, why should we be more aggressive? Why shouldn't we wait until things really accelerate? Then we can step on the tightening. And in a way, if they pass on the March meeting, I think they're behind the curve. And they're intentionally behind the curve.
Which
and I think
good for tips, though. Let's be clear, that should be good for tips.
Believe me, it will be good for all risk assets. If a very dovish Fed means they're over-accommodating for longer, so everything should go up. But the yield curve should steepen quite a bit.
Chuck Stevens also, as CFO of GM, has to be thinking about the dollar, because they had some adverse FX, we didn't get into it, but adverse FX effects. In fact, they drove down their margin in the fourth quarter. What would happen to the U.S. dollar if, in fact, the Fed woke up tomorrow and said, yes, you're right, let's be at 2?
I don't know that too much would happen. Like all markets, the dollar has moved a very long way, and it's consolidating. And if you look year to date, and you look at the Brazilian real, or you look at the Russian ruble, those are up about 4% year to date. So there's already been some of the spume in the dollar has come off, and you're seeing the emerging market currencies start to pick up a little momentum in here.
Well, that might be, but if you look at the markets, they are not pricing in the sort of rate hikes that you're talking about right now. They still think they're more dovish, actually, than the Fed is in their dot plot. Well, so there would have to be some adjustment in the markets if, in fact, they came up to the dot plot or above it.
Well, you're right. But they have moved from 1 to 2 hikes to 2 to 3 hikes, and you do have people like Harker out there saying, hey, why isn't March on the table? There's a lot of time to pass. There's about a month to go before the March 15th meeting. You're going to get more employment data. You're going to get more corporate earnings. And I think it should be a live meeting. I'm not saying that they're going to go. I think they should go. And I actually think we need the Fed to be the Fed again and get to a normal level of interest rates before all this policy stimulus does take form and it gets away from them.